There's a version of the American dream that goes like this. You work hard, you save what you can, you put your retirement money into a low cost index fund, and you let the market do the rest. You don't pick winners. You don't try to time anything. You keep contributing month after month and trust that the system works. For decades, that was good advice. It may still be the best advice available, but it rests on an assumption most of us rarely stop to examine. We think of the index as neutral, just a picture of the economy, a measurement. But it isn't something that exists in nature. It's built. Someone decides what counts. Someone decides what gets included. Someone decides when the rules change. I started thinking about this because of a welder named Juan Hernandez. In 2015, a friend told him to apply for a welding job at SpaceX. He had never heard of the company. He started as a contractor making $28 an hour. Later, when he became full time, he got about $10,000 worth of stock. He didn't think much about it. As he later said, it didn't seem like a big deal. He didn't know much about it at the time. Then on June 11th of this year, SpaceX went public at $135 a share. Juan's remaining shares were suddenly worth more than $1 million. He became a millionaire from a job that paid him less than $60,000 a year. Now, that story is real. He earned it. But it also became part of the sales pitch. And once you start looking at what's being sold, who's buying it, and how little choice some of those buyers may actually have, the story starts to look very different. Welcome back to Interconnected. Juan Hernandez got rich. More than 4,000 SpaceX employees became paper millionaires when the company went public. Welders, cafeteria workers, engineers. It's an extraordinary story of wealth creation. And when you hear a story like that, the reaction is almost immediate. Maybe you think, I want in. Maybe you think, I missed it. Maybe you were one of the millions of people who requested shares in the biggest IPO in history and got allocated 17. I keep thinking about this. The company that went public 10 days ago lost nearly $5 billion last year. Since it was founded, it has built up more than $41 billion in total losses. It's trading at roughly 141 times trailing revenue. Google went public at about 7 times revenue, Facebook at about 20. Morningstar's analyst puts fair value at $62 a share. The stock is trading above 200. And if you own a retirement account tied to the NASDAQ 100 or the Russell 1000, if you have a 401k, an IRA, or a passive index fund, there's a good chance you're about to become a SpaceX shareholder, whether you want it or not. That's not figurative. Within weeks of the IPO, retirement funds that track those indexes will automatically buy shares of this company. Nobody asked you first. You woke up holding that risk. Now, that's the part I really needed to understand. Not because SpaceX is a bad company. It has done things no other company has done. It's because the story being told about this IPO and the way it actually works is very far apart. And that gap didn't happen by accident. It came from a system that changed while most of us were watching the rockets. The excitement around SpaceX is not irrational. It comes from nearly 2 decades of extraordinary engineering. SpaceX landed a rocket booster on a barge in the ocean. Then it kept doing it. It built Starlink, the world's largest satellite internet network. It became the dominant launch company on Earth. It has done things NASA and the old aerospace giants couldn't do or didn't do. If you watched the first Falcon 9 landing, you probably felt something. So when the IPO was announced, the pitch was incredibly powerful. The most audacious aerospace company of our era finally going public. Ordinary people, supposedly, were finally going to get a chance to take part. And many of them did. SpaceX set aside roughly 30% of the shares for retail investors, about $22.5 billion worth. That is unusual. Most IPOs send the overwhelming majority of shares to institutions. This one felt different, more public, more open, more democratic. The IPO raised $75 billion at a valuation point of 1.77 trillion. The stock jumped 20% on the first day. Elon Musk became the world's first trillionaire. And if you were one of the millions who requested shares, you probably got far less than you wanted. One investor requested 1,000 shares through Robinhood. He got 17. He sold them within days. He called the valuation outrageous, stupid, and unreasonable. He bought anyway. Think about that. So I want to bring in a composite here drawn from real conversations and real experiences because I think it captures something important about the kind of market we're in and the kind of buyer that market produces. I asked him why he bought. He said, "You want me to say something smart, right? You want me to say, I believe in the mission, colonizing Mars, the future of humanity, all of that." He laughed. "I don't believe any of that. I mean, I believe they're going to try, but I'm not buying because I think Mars is going to make me money. I'm buying because I think the stock is going to go up." So I asked him, "That's not really an answer. You said the valuation was stupid." And he said, "Yeah, it is. And I still made $400 in 2 days." I didn't have much to say to that. He kept going. "Look, I'm not an idiot. I know what I'm doing. I'm playing a greater fool game. I'm buying something overpriced because I think someone else is going to buy it from me for more. That's the game. That's what the market is now. You can tell me the system is rigged, but I still made $425. So on his terms, he's right. And that matters because once enough people behave that way, the behavior itself starts shaping the market. It helps keep alive a market where price and value no longer need to make sense in the old way. At a glance, the public story works. A visionary company goes public. Regular people get to participate. The stock goes up. Then you start looking at the numbers. SpaceX lost nearly $5 billion in 2025. Its prospectus reports adjusted EBITDA of $6.6 billion, which is one measure of operating performance, but a GAAP net loss of $4.9 billion. The gap comes from capital spending, stock-based compensation, debt, and losses from the AI business. Since 2002, SpaceX has built up total losses of $41.3 billion. Now, that alone does not mean the company is worthless. Companies can lose money for years and still become enormously valuable. Amazon did. Tesla did. The question is what investors think they are buying when they pay this price. SpaceX went public at roughly 95 times trailing revenue. Using 2025 revenue, it lands at about 141 times sales. Google went public at around 7 times. Facebook at around 20. Even by the standards of expensive growth companies, this is extreme. Morningstar's analyst assigns fair value at $62 a share. The stock is trading above 200. That makes it one of the most expensive stocks in Morningstar's coverage universe. And then there's the other issue. A lot of people still think they're buying a rocket company, but the company being sold to public investors is presenting itself very differently. Its S1 anchors the story to a $28.5 trillion total addressable market. 93% of that is AI, not space. That's because the February 2026 merger with xAI, Musk's artificial intelligence company. The company that went public is the combined SpaceX, xAI / X business. So public investors are not just buying rocket launches and satellite internet. They are buying a conglomerate that spans launch, broadband, AI, and social media. PitchBook described it as a different company from the one that built its reputation on rockets. AI infrastructure, driven by compute agreements with Anthropic and Google, running at roughly $26 billion annualized, is now the largest business by revenue. Most of that AI business was added just 4 months before the IPO. So if you think you're buying the rocket company that built reusable boosters and talks about Mars, that is at best incomplete. What is actually being sold is a conglomerate whose biggest revenue engine is AI compute and whose market story is now overwhelmingly AI. Now that matters because the rocket company goes public story is doing an enormous amount of work. It is emotionally sticky. It is easy to grasp. It feels intuitive, but it no longer really matches the thing being offered. When you see that, you realize, and once you see that, the governance starts to matter a lot more. After the IPO, Elon Musk will hold roughly 85% of the voting power. Public shareholders will have, in the company's own words, no practical ability to influence outcomes, no matter how large a stake they accumulate. This goes beyond the usual tech dual class structure. Meta has dual class structure. Alphabet has dual class structure. This is more extreme. There is no sunset provision in this chapter. So if Musk dies or becomes incapacitated, voting control does not return to public shareholders. Through a transfer clause, Class B shares can pass to Musk's heirs and still keep 10 votes per share. In other words, control is built to continue. There is also a corporate opportunities waiver. That means Musk and his other companies can pursue deals that might otherwise belong to SpaceX, and public shareholders have very little recourse. There are also Class C employee shares with no votes, a Texas domicile, and mandatory arbitration clauses. So what you are buying is an economic stake without real control. You cannot shape outcomes. You have very limited recourse. And the company is not built around normal shareholder protections. Institutional investors noticed. Morningstar raised governance concerns. The New York City Comptroller's office criticized the structure. But none of that stopped the IPO from becoming the largest in history. And none of it stopped the stock from jumping 20% on day one. That matters for another reason. A lot of people are going to own this stock without ever choosing to own it directly. So I want to bring in another composite voice here. Again, based on real conversations, because this is where the issue stops being about traders and starts being about ordinary savers. She's a financial advisor. She manages retirement accounts for mid-career professionals, teachers, nurses, people who are not watching CNBC all day. I asked what she's telling clients about the SpaceX IPO. She said, most of them have not asked. Nobody's calling me about SpaceX. They're calling because they're worried about inflation, or they want to know if they're on track for retirement, or their kid is going to college. The IPO is huge in business news, but my clients aren't following it. They're busy. Then I asked her about index inclusion. She paused and then she said, okay, that's different. She explained that most of her clients are target date funds or broad market index funds. They do not pick stocks. They do not follow individual companies. That is the point. For years, the advice has been simple. Don't try to beat the market. Don't pick winners. Buy the index. And what bothered her was also simple. The index isn't just sitting there. It's a list. Someone decides what goes in it, and the rules just changed. In May, NASDAQ changed its rules to allow faster inclusion in mega IPOs into the NASDAQ 100. The waiting period was cut from 3 months to 15 days. SpaceX's 4% float at IPO would have made the company ineligible for broad index fund inclusion under the old rules. The rules changed in time to make room for the IPO. That means passive funds tracking the NASDAQ 100 and the Russell 1000 may have to sell billions of dollars of Apple, Microsoft, Nvidia, and other existing holders in order to buy a single low float newcomer. And if you have a 401k in a NASDAQ 100 tracking fund, there's a very good chance you have no idea this is happening. You've never heard of the fast entry rule change. You may not realize that within weeks of the IPO, your retirement fund could be buying SpaceX shares at whatever price the market sets without making any judgment about valuation and without giving you any real say in return. The advisor I spoke to put it this way: I chose passive investing for my clients because it was the safe, boring, responsible thing. Nobody told me the rules could change to put a money losing company into their retirement accounts inside of 2 weeks. And now I have to figure out what to tell them. The index fund is still the best tool I have, but it's not the same tool I thought it was. Then she said something that stuck with me. I can't tell if I'm overreacting or if the system changed and most people didn't notice. I don't think that's paranoia. I think that's the right question. What happened here is not mysterious once you line up the parts. SpaceX went public with a tiny float, about 4% of shares. Scarcity helps support the price because demand is chasing a limited supply. Then more shares begin to come to market over time. That can increase SpaceX's eventual weight after fast track index inclusion. Nasdaq cut the eligibility window to 15 days. The S&P 500 did not relax its profitability rule, but Nasdaq and Russell moved in a more permissive direction. Then passive index funds have to buy. So when automatic price insensitive buying hits a newly listed company with a tight float, you can get serious price distortion. Meanwhile, the underwriters, Goldman Sachs, Morgan Stanley, and Bank of America, collect fees on the largest IPO in history. Early investors realized extraordinary gains. Founders' funds estimated returns exceed $50 billion. Andreessen Horowitz's stake is worth more than $10 billion. Sequoia is over $20 billion. Musk crosses into trillionaire territory. The New York City's Comptroller's office put the argument bluntly. When multiple index providers lower their inclusion standards to make room for the same handful of IPOs, that is not neutral market representation. It becomes a race to the bottom. Trillions of dollars in passive assets get pushed into securities that would not have qualified under the rules in place only months earlier, exposing ordinary investors to volatility they never willingly signed up for. One analyst called the index rule change the dark side of this IPO. His view was that Nasdaq chose fees and deal flow over credibility and over the safety of passive investors' money. And then there's the political side. Musk's companies have drawn $13.5 billion in federal benefits and at least $9.5 billion in direct Defense Department contracts. At the same time, as a special government employee leading DOGE, Musk was in a position to influence some of the agencies that regulate and contract with SpaceX. DOGE terminated contracts for many vendors, but none for Musk's own companies. That creates a kind of political risk that is highly unusual for a defense contractor. And the IPO turns the market value of that position into public stock market value. Going public converts political advantage, regulatory posture, and government contracting relationships into stock market capitalization. I put a chart on the blog mapping those overlapping relationships between SpaceX, federal agencies, and the DOGE initiative. It's easier to understand visually than in a spoken paragraph. But by this point, the picture should already look different from the one most people think they're seeing. This is not simply a beloved rocket company opening itself to the public. It's a conglomerate whose biggest story is AI, trading at extreme multiples, controlled by a founder with overwhelming voting power, and entering major indices under changed rules that force passive funds to buy it. And that last part may be the most important. For a generation of investors, just buy the index meant something simple. Trust the method, trust the rules, trust that nobody was quietly redesigning the product underneath you. If index construction becomes something issuers can effectively shop around and pressure providers to accommodate, then the thing people mean when they say the index has changed. And this probably does not end with SpaceX. Anthropic and OpenAI are already discussed as next possible examples. I want to go back to Juan Hernandez because his story complicates all of this. Juan earned his money. He spent years welding rocket components. He accepted stock as part of his compensation. He held it when he could have sold in tender offers. He took risks inside the company, and the bet paid off. When the IPO priced at $135 a share, his roughly 6,500 remaining shares were worth more than $1 million. That is a good outcome. I don't want to deflate it. But Juan's wealth was created inside a private company for more than a decade. He was building the thing. He had a fundamentally different relationship to the company, the risk, and the timing. The public offering is a different bet sold to a different audience. And the employee millionaire story helps market that bet. The employees deserve their moment. They earned it. But the story of the welder who became a millionaire is also being used to sell shares to people who are not insiders, who will not get the same price, who will not have the same information, may not even realize they're buying it through index exposure. That tension is real. And I don't think it disappears because one side of it is emotionally satisfying. The same goes for the Marvin Jung problem. Marvin called the valuation stupid. He bought anyways. He made $425. My first instinct is to call that irrational. But it isn't irrational if the market is rewarding narrative momentum and forced buying more than it rewards discipline about underlying value. He's not confused. He's responding to incentives, and that points to something darker. The standard advice, be careful, do your research, invest based on fundamentals, may still be morally sound, but it may also be drifting further and further away from how gains are actually distributed in the market. So the question is not whether SpaceX is overpriced. Clearly it is. The deeper question is what happens to a society when prudence matters less than access, timing, and narrative. I don't think there's a clean answer for that, but I do think there are a few questions worth keeping in front of us. If you own index funds, and most American adults saving for retirement do, you may soon hold SpaceX without ever choosing it directly. So the real question is less, should you buy SpaceX? And more, how much choice do you actually have? If you're outside the trade watching this happen, there's another feeling underneath it. The biggest wealth creation event of your lifetime seems to be unfolding in front of you, and you're not part of it. At the same time, there's the suspicion that jumping in may be exactly what the system is counting on. For policymakers, the question is whether the index providers should be allowed to change inclusion rules around specific IPOs at all. If they do, what is the index measuring, and who is it protecting? For the financial industry, the question is what responsibility it owes passive investors whose money is being moved under a changing rule set they never agreed to. I don't think this is the last time we're going to face that problem. The next IPO is already coming. We started with a familiar version of the American dream. Work hard, save what you can, put your retirement money in an index fund, and let the market do the rest. That advice is probably still the best advice available. I'm not telling you to sell your index funds. I still own index funds. But an index is not merely a neutral reflection of the economy. It is built. The rules can change. And when they do, your money can be moved into places you never consciously chose. The SpaceX IPO is the largest in history. It minted a trillionaire. It made more than 4,000 employees into millionaires. It let some retail investors make a quick profit, and it may have changed the relationship between passive investing and corporate power in the American economy. The welder got rich. He earned it. But the system that produced his wealth is now offering a different trade to a different audience, and some of that audience may not even know they're in it. If the rules can be changed to make room for a single company, then it's worth asking who those rules are really for. Next time on Interconnected, I want to follow the question that comes out of this one. If the biggest IPOs are now being structured in ways that force index funds to buy them, and Anthropic and OpenAI are next, what does the index look like in 5 years? And what does that mean for the retirement accounts of people who never asked to be part of that experiment? See you next time.